Hi guys, Mike Frontera here, back with another retirement theory video. Well, this has been no doubt one of the most surreal years that I can remember. The coronavirus pandemic has turned so much of what we consider normal life right on its head. Now, Jay Leno made an appropriate joke. He said, "I got in trouble at the bank the other day. I was the only one not wearing a mask." But seriously, folks, well, for most of us, coronavirus has been no laughing matter. And putting aside the obvious health risks and, the many people we've lost from the virus, the toll on the economy has been astronomical. In states all across the country, thousands of businesses have been forced to close down for weeks or months, only to be followed by this painfully slow and heavily restricted reopening plans. And this crippling economic situation, it's playing itself out in various degrees really all over the world, which is why it's absolutely puzzling to so many people why we'll hear on the very same newscast telling us about cities never returning to normal and Great Depression-like unemployment, that the S&P 500 just hit a record high, and that the NASDAQ has been hitting record highs since June. So somebody please explain what is going on here. Well, the good news is it isn't magic. In fact, it's not even terribly surprising. In fact, there are three perfectly logical reasons why we're seeing this illogical scenario play out. First, the market is not the economy. You may have heard this before as an expression, and it's true to a large extent. One way it's especially true is what we're actually identifying when we say the market. Think about it for a second. What does the market mean? What does the stock market mean? Well, for a lot of people, it's what they see on the news. Whenever they do the market recap. Basically, the most reported on stock market indexes, Dow Jones Industrial Average, NASDAQ, and the S&P 500. Now, all three of these are what are called cap-weighted indexes, meaning the larger the company in the index, the bigger percentage of the index it makes up. So what we're really looking at is some of the largest companies in the world, and even then, it's skewed heavily toward the largest of those. All right, let's start with NASDAQ. As of July 22nd, just 6 companies, Apple, Microsoft, Amazon, Facebook, Google, and Tesla, made up 41% of the NASDAQ, in an index that has more than 2,700 stocks. How about Dow Jones Industrial? Here again, with just 6 companies, Apple, United Health Group, Home Depot, Microsoft, McDonald's, and Visa, making up about 42% of the index. And the S&P 500? Their top 6 stocks? Apple, Microsoft, Amazon, Facebook, Google, and Johnson & Johnson, make up just about 25% of the S&P 500, despite the index having 505 member companies. And you may have noticed a lot of overlap here, and that most of these companies are involved heavily in technology. Now, as we've quickly fast-forwarded progress on remote working, shopping, delivery, almost every part of our daily lives, tech companies have been a huge part of that. So, the first reason is that when we're looking at what we consider the market, we're truly not looking at the economy as a whole. Instead, we're mostly looking at the largest corporations within the economy, and again, even then, we're looking heavily toward those that have benefited from our heavier reliance on technology. So to say it succinctly, what we informally call the stock market does not represent the full economy. The second reason why stocks are disconnected from the economy is that when we buy a stock, we're generally making a prediction of the future rather than a reflection of the present. In other words, most logical buyers of stock are hoping for the price of that stock to go up in the future. Let me give you a quick example. Which stock would you rather buy? Stock 1 of ABC Company, who's had a great history of profits and is one of the most recognizable companies in the world. But you just heard on the news that the CEO is under investigation. All right, he's allegedly orchestrated some scheme that sells its customers' private data to a foreign government in exchange for billions of dollars in large project contracts. All right? Or company 2, who's had a decent revenue but hasn't yet reached profitability, but they just announced a ready-for-market new battery. This battery can drive a car across the country on a single charge or power homes and businesses for a tiny fraction of what people are used to paying. Well, despite the less attractive current financial situation for Company 2, we'll call XYZ, I think most people would prefer purchasing the stock of that company, assuming that the future appears much rosier than it does for ABC. And so it goes for the stock market. People buy based on what they think will happen, not on what's happening right now. So then it stands to reason that the market is pricing in some amount of optimism about the recovery of the economy in the somewhat near future. And should news develop that would be counter to that, well, the market would likely react by selling off. And as we've just seen, the markets react pretty fast to news. The news of the coronavirus and the ensuing shutdown sent the S&P 500 down 34% in just over a month, from February 19th to March 23rd. During that, there was a lot of speculation about how bleak the economy would get and to what degree the government would step in and support the economy during that time that was, largely unknown. And that support came in, and the prospects for a truly dire situation started to dissipate. Well, then investors began putting money back into stocks. So what future pain for the economy is expected and anticipated pain has already largely been factored into those current pricing levels. It's more that the change of anticipation would likely alter prices going forward. This brings me to the third reason between the disconnect of the stock market and the economy. And this reason is tied to the previous two pretty strongly. That is, we've had a tremendous level of government support and the Federal Reserve to keep the economy functioning somewhat normally during this time. And it's the expectation that this support will continue as needed until the pandemic largely subsides. So I think I kind of opened a big can of worms by saying the government and Federal Reserve support. There are a number of areas where this support has been given, mostly of which has been deployed rapidly and on an unprecedented scale. The proverbial kitchen sink of tools has been thrown at the problem. Unemployment, for example, shot up over 14% almost instantly during the initial forced COVID shutdowns, directly following some historically low employment numbers to boot. Just looking at the unemployment chart is visually striking. However, emergency unemployment benefits were quickly passed, granting Americans an additional $600 a week in benefits. Add to that state benefits, and a lot of people who would otherwise have found themselves in immediate financial trouble found themselves making more than they were making when they were working. Businesses were granted relatively easy loans, some of which were entirely forgivable, just to keep people on payroll too. Finally, let's talk a second about interest rates. The Federal Reserve Bank almost instantly lowered short-term rates to about zero during the early days of the pandemic. And you just can't underestimate the power of low interest rates. Now, if you're going to go down the retirement theory video rabbit hole, which I think you should, I recommend watching Who is the Fed and Why They're So Important. I'll put the link here somewhere at the bottom in the description. Now, if you don't have the time to watch, let me give you the 3 quick ways that lower interest rates help stocks. The first is the direct impact. Stock prices are generally thought of as the present value of all future cash flows. And this calculation uses interest rates to determine how much to discount those future flows. So the bottom line is that lower interest rates leads to less discounting and consequently higher prices for stocks, all else being equal. Number 2, and this is also a big one, it makes other assets like bonds, CDs, and money markets all less attractive versus buying stocks. As of the end of July, a 10-year Treasury bond pays just 0.55%. That's obviously much safer than stocks, but it's questionably attractive for an average investor to plunk down serious cash for 10 years in order to get a little better than 0.5% interest. And third is that so much business is conducted on credit. From mortgages to business loans, all loans suddenly get cheaper. That means a business can borrow more money for the same interest cost, or conversely, with the same level of borrowing, can enjoy a healthier bottom line. So this drastic reduction in rates, which were already at low levels, was just one more shot in the arm of the stock market and ultimately the economy. Finally, we of course still don't know where things go from here. The virus could have a bigger effect than was expected, or it could suddenly become yesterday's news with the advent of an effective vaccine or treatment. We can all expect, though, is that stock investors will continue to attempt to anticipate the future of the economy long before what actually happens in the economy comes to pass. So, do you have questions for me? Let me know. Come visit me at www.retirementtheory.com or send me an email at mike@retirementtheory.com. Did you click subscribe on this video or follow me on Facebook? I think that you should. You'll continue to see videos like these on everything retirement planning. Once again, thank you for joining me. Take care of yourselves, and we'll see you next time.